Good evening, friends. Welcome to this fourth webcast in this series of Unlock Budget 2021. Today, we want to discuss a very important topic which affects all businesses on a daily basis or on an everyday basis. And we will discuss TDS at some length. And then there are certain other things which have been some changes which have been made in the budget, which may have missed attention of a lot of people, but nevertheless they are significant, especially changes in relation to PF contributions, changes in relation to ULIPs, changes in relation to leave travel concession in this COVID period when the travel is virtually non-existent. So I think it should be all in all, it should be a good session. And I think uh, the more relevant part for businesses would be the changes in the TDS provisions. And I have no hesitation in saying that it is really becoming more and more tedious to comply with the TDS provisions. So I'll request Palak to give a short introduction and then we can start. Palak.
So,
Yeah.
good evening, everyone. I take honor in welcoming you all to the fourth webcast of Budget 2021 Unlock series organized by Acupro, where we unlock two topics each day. Today, we'll deep dive into our next topic of the series. When you retire from your job, your salary stops, but your expenses don't. So, if you want to ensure that your daily expenses are taken care of and that your lifestyle is maintained as before, a good retirement corpus is absolutely necessary. This is where Employee Provident Fund can come to your aid. Some major proposals were brought regarding Employee Provident Fund in the Budget 2021, which we'll decipher in today's webcast. Also, we'll pave our way through other provisions relating to employee benefit expenses. Moving further, our second topic for the day will be proposals relating to TDS and TCS. The concept of TDS was introduced with an aim to collect tax from the very source of income. The authorities have confirmed through the proposals in this budget that they are resolute in covering as many transactions in its scope. That we'll learn how. Participants are requested to put the queries related to the topic in the chat box provided. or can ask directly at the end of the session. Now, I request respected Alok sir to take over and enlighten us with his valuable analysis.
Thank you, Palak. I mean, that was a very good introduction to this session. Uh, and I like your uh, use of the word resolute in by the government in 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 implementing the TDS provisions, and they are actually TDS is everywhere now, right? Uh, so let's start with this session. Uh, so the first thing that we're looking at is taxation of employee benefit expenses. So in this budget, what they've done is they've made two different changes. One impacting the employer, and the second impacting the employee, right? And these are significant because a lot, I mean, both employers were benefiting from certain court decisions uh, while they were not depositing the PF which they used to collect from the employees. And the second, employees were able to uh, accumulate higher amount in their PF by making a voluntary contribution, or in case of employees deriving higher salaries, uh, their contribution in any case was higher, and they could still derive exempt income at the end of their term with the employee. So we'll see what they have done to plug or to uh, plug this issue, or in fact, I would say that it could be a little harsh also, though the justification given by the government is something different. So we all know that under Section 22410 uh, of the Income Tax Act, it says that any sum received by the SSC or by the taxpayer from employees as contribution to the Provident Fund or ESI will be considered as the SSC's income, right? So this is what uh, Section 22410 says. So first is so if the employee deducts uh, PF from the employee's salary, that is considered as an income of the employer. Then there is this section 36(1) clause 5A, which says that a deduction of the aforesaid income or the aforesaid contribution is allowed in the hands of the employer, provided the same is credited to the employee's account in the relevant fund on or before the due date of the respective statute. For example, the Provident Fund Act. Uh, this is what the law is. And then there is another section, section 43B, which says that so we are all aware that there is generally an equal contribution by the employer towards the provident fund of the employee. And section 43B says that sum payable by a taxpayer or by an SSC as an employer by way of contribution to PF ESI will be allowed on a payment basis, which means in case the employer has paid his own contribution, that will also be allowed as a deduction, but only on a payment basis. And then there is a provision in section 43B which says that liability for the relevant previous year is allowed if same is deposited, paid on or before the due date of furnishing of return of income of that year. So uh, there are two components. One is employee contribution, which is first considered as an income of the employer, and then it is allowed as a deduction in case the same is paid before the due date as per the respective statute, right? And then there is employer contribution, which is a contribution made by the employer on its own, and that is an allowable expense under 37, but it is there is a section 43b says that it will only be allowed when it is paid, and then there is a proviso under 43b which says that yes, it will be allowed in case you pay it before the due date of furnishing of the return of income for that year. Now with this position under the act, what was happening was there were certain instances where the contribution and generally the contributions are paid together. So the employer and employee contributions are collated or are paid together by way of one challan, right? So both employer and employee. So a lot of times what used to happen, there used to be some delays on some account or other, and the payment was cumulatively paid to the authorities, and the employer used to claim that I have paid the amount within the due date permitted under 43b, and therefore I should be allowed a full deduction. So employee contribution became my income, but since I paid this amount within the time allowed under 43b, which is within before the due date of furnishing of return, I should get a deduction for the entire amount. And this was also upheld by various courts, and this was also upheld by various courts. The Delhi High Court was AML. It took the concept from Vinay Cements, and this is how SSEs were or taxpayers were now taking a position that even if there is a delay in payment of employee contribution, as regards the I mean, the employee contributions normally would have to be paid by 15th of the following month. But even if there is a delay in that, as long as the payment is made before the due date of filing of tax return by the employer, a deduction is permitted. And this was supported by all these case laws. Uh, in fact, the government also came out with a circular that their intention is not to cover employee contribution within 43B, and 43B is only for employer. But still, courts continue to hold that no, even employee contribution, for employee contribution, the date has to be reckoned with what the date is for 43B. And there were some reasons for that. So I'm not going into that. Uh, and as similarly, there were certain adverse decisions also on this issue, wherein it said that employees' contribution can only be allowed as a deduction if deposited within the due date prescribed under the relevant statute and not otherwise. And this is the circular that I was talking about. This was the circular which was issued by the CBDT, but even after this circular, some of the courts said no, the correct position is that the due date should be taken from section 43B and not 36(1) clause 5A. Now, in this budget, they have sought to put this controversy to rest, and it is proposed to amend section 36(1) 5A and 43B by insertion of explanations. Uh, so, in explanation 2, in section 36(1) 5A, they've given this explanation: for removal of doubts, it is hereby clarified that provisions of 43B shall not apply and shall be deemed never to have been applied for the purpose of determining the due date. So they're making it explicitly clear here. Similarly, in 43B, they've inserted explanation 5 and they've said, for removal of doubts, it is hereby clarified that the provisions of this section shall not apply and shall be deemed never to have been applied to a sum received by an SSE from his employees to which provisions of uh, clause 10 of subclause 10 of clause 24 of section 2 applies, which is employees' contribution. The amendment therefore seeks to provide that the deduction of employees' contribution shall be allowed only if the same is credited by the employer to the employee's account in the relevant fund on or before the due date prescribed under the relevant act. Now, the rationale which has been given by the in the memorandum is that is on a this is that because employers may delay the deposit of employee contributions, employees lose out on earning interest on that, and that's not desirable. And in any case, employers have no business in retaining the amount which they have deducted from the employee for depositing with the PF authorities. So that's the essential reason which came out from the speech of the Honorable Finance Minister also. Uh, so obviously the amendment nullifies the decisions which allowed employees contribution deduction on payment basis as covered in the 43B. Uh, there was an internal circulation on 10th September 2018 from the office of the principal DGIT, suggesting withdrawal of departmental SLPs against the issue. But I guess now they put that to rest, and their clear position which comes out is that they are not going to allow any delay in employee contribution, delay in deposit in employee contribution. And it's very important to note the way they have inserted this explanation. They've used the word for the removal of doubts, which means if anyone have had at any time any doubts, and generally this language is used when you're trying to do a retrospective amendment. It says for the removal of doubts, it is hereby clarified that the provisions of section 43B shall not apply and deemed to have never applied. This is the language that they have used. Now, here probably there would be some debate as to how this would be construed in past cases where employers have already taken this position, that whether this amendment, whether taken this position that delayed employee contribution, as long as it is deposited within the due date of filing of return, should be an allowable expense. How that will pan out in view of this language used in this section. Though the amendment says that it is applicable from 21-22 and subsequent years, but this language, to my mind, will create some issue when it comes to granting benefit or granting relief to the employers in respect of past delays. So this is on this. The other change that they've done is on the contribution that an employee makes to the PF. So this is also very significant because it impacts a lot of people. Uh, so under section 10 and 10.11 and 10.12, that section excludes a certain income in the computation of total income. It excludes any payment from a provident fund to which PF Act 1925 applies, or from any other provident fund set up by the central government and notified by it in its behalf. Similarly, what is exempt is accumulated balance due and becoming payable to an employee participating in recognized provident fund to the extent provided in Rule 8. Now, this is what these two sections are. Essentially, this would mean this would include PPF, and this would, in normal circumstances, have PF, your employee PF. Right? Generally, when there is an employee PF account, there are two contributions and matching contributions, except in certain cases. So contributions are from the employer as well as the employee. There is a contribution of 12% by both, while that of the employer is split into two. Uh, so there is 8.33% and 3.67%, and the employee contribution is 12%. Uh, this contribution earns an interest, and the government generally announces an interest rate during the mid of the year as to what is the interest which it had earned in the last financial year. And it generally ranges between 8 to 9%. That has been the experience in the past decade. In addition to this, a lot of employees also voluntarily contribute to the provident fund, which is also known as voluntary provident fund. And there the employees contribute with a view that whatever I contribute, even though I do not get 80C for that, I still am able to earn a tax-free 8 to 9% interest, because all this was exempt under 1011 or 1012. So whenever this money came back to the hands of the employee after his retirement or resignation, uh, this money was exempt in his hands. Uh, so this is what used to happen. So a lot of 8 to 9% tax-free interest translates to some 11 to 12% return pre-tax, right? And which is a decent return in present times when the interest rates have fallen to 4 and 5%, right? So this is what a lot of employees were doing, and the government thought that this is something which is not desirable, because they're taking an advantage of this section and ending up not paying taxes on this interest income. And I think the target was more for employees having higher income, and that's the reason they said that uh, what they've done is that effective 1st April, uh, so which means effect, this is assessment year, so this would be 1st April 2021. uh, Interest on an employee's own contribution is to attract tax where his contribution exceeds 2.5 lakhs in a year. So so whether that contribution is on account of EPF or on account of VPF, if the aggregate contribution exceeds 2.5 lakhs, then any interest that the employee earns on the excess amount is taxable in the hands of the employer. Now, the if we do a rough calculation or a back of an envelope calculation, it's going to affect employees with a salary above 20.8 lakhs, because their 12% translates to more than 2.5 lakhs, or just about 2.5 lakhs. So if we were to take an illustration, there is an employee with a salary of 30 lakhs. He contributes an EPF of 12%, which translates to 3.6 lakhs. Then the interest is taxable on 1 lakh 10,000, which is 3.6 lakh minus 2 lakh 50,000. Now, these are two different sections, 1011 and 1012. So there could be a question that, okay, I contribute 1.5 lakhs to a PPF, right? And I contribute 2 lakhs to the EPF. So will there be a disallowance of uh, 1 lakh? The answer is no. Uh, so these are two different sections, and the limits would be constituted separately. So you can continue to contribute 1.5 because that's the limit that you can contribute to PPF. In EPF, you can contribute up to 2.5. and still have a benefit of interest on this 4 lakh as exempt. This is one clarification that I wanted to give. The other issue which comes up now is how will this amount get taxed? In which year will this interest be taxed? Will it be taxed in the year in which it is earned, or will it be taxed in the year in which the employee withdraws that amount? Uh, so I think the answer is not there readily there, but I mean, if we go by the principles that we follow for tax purposes, as an individual can either adopt a cash basis for offering interest income or accrual basis. So it will, to my mind, it will be left to the choice of the individual whether he wants to offer this income on an accrual basis or he wants to offer this income when he actually receives it. This is one issue. The second issue which will come up is how does one know what is the amount of interest which is taxable? Now that's going to be a little tricky, especially as years go by, right? So I'm sure there will be some mechanism that the government will come out wherein they will be able to actually bifurcate and tell the employee, okay, this much amount is tax free and this much amount is taxable. That has to happen. Otherwise, how will an employee offer that income to in his return of income? So this is the second issue which I foresee here, because a lot of times interest is what the government announces this interest quite late. What is the interest on the PF? And if that announcement is beyond the filing due date of filing of return, then there is a practical difficulty. How is an employee going to report this, right? As of now, I don't know whether there will be a TDS obligation on this by the PF authorities. Uh, that's not there. It doesn't seem that it's there as of now, but one will have to wait and see how this is looked at. Or will the government introduce something of this sort also? Uh, so this is on the employee PF. Another similar thing which the government has done in this budget is they realize that a lot of people buy ULIPs, and ULIPs are exempt under 1010D. Uh, exemption of in respect of sums received under an insurance policy subject to fulfillment of conditions therein. Uh, Now, what the government is saying that ULIPs are essentially uh, investment linked products, or I mean, they essentially invest in equity and such kind of instruments. So those instruments, when someone invests in an equity oriented fund or a debt oriented fund, that person is generally subject to taxation. But in case someone invests into those funds through an ULIP, then there is no taxation. So there is some arbitrage here. That's what the government feels, and therefore they have now amended this, and they've said that we will only allow premiums up to 2.5 lakhs in a year in an ULIP instrument, and in case uh, premiums exceed that amount, then the exemption under Section 10D will not be applicable or will not be available. Uh, so this is what the government has done, and as a consequence, they have classified such ULIPs which exceed 2.5 lakhs as a capital instrument, and they are wanting to tax such ULIPs as in the similar way as they would tax investment in a equity oriented fund, which means as capital gains. And they've also covered this within 112A. uh, amended the definition of equity-oriented fund to include unit-linked insurance policies, which means the taxation would be, say, at 10%, right? 10% plus surcharge and cess. So this is another change that has been done. Again, I think the issue would be how do you calculate, how do you bifurcate, and all that. Uh, so this is what I discussed. These amendments, what is more important is these amendments come into effect from 1st February 21, which means ULIPs issued on or after this date get impacted, where aggregate premium in the year exceeds 2.5 lakhs. And this section, I mean, the taxability happens from assessment year 21, 22, and thereafter. Uh, Now, this is the government this year, as a one-time measure, has given a concession in the leave on the leave travel allowance or the leave travel exemption that employees used to claim. Because of the COVID, people couldn't travel, and their entitlement for the block of the years 2018 to 21 uh, could lapse, right? So the government thought, uh, let's bring out an alternative scheme where people can actually avail LTC and still not get taxed, even though they were severe restrictions on travel. Uh, so what the government has done is that it has it is provided through insertion of a provision that tax exemption shall be granted to cash allowance in lieu of LTC for the block of 2000, uh, yeah, 17 to 21. It should be 18 to 21 probably. Yeah, subject to fulfillment of certain conditions. Uh, so they've announced a special package. I mean, this was announced during the COVID times, sometime in October. Uh, and earlier it was announced for only government employees, and later on this was extended for non-central government employees also, and along the same lines as for government employees. Now, what the scheme is essentially, it says payment of cash allowance subject to a maximum of 36,000 per person, and this is per person in the family of that employee. So if there are four people in the family, then 36,000 into four as deemed LTC fare per person. So 36,000 is deemed LTC fare per person round trip, shall be allowed income tax exemption subject to fulfillment of these conditions. So one, uh, that amount can be used to purchase any goods or avail any services. Uh, and the only condition is that those goods or services should have suffered at least a 12% or higher GST. Uh, Second, the payment should be by an electronic mode or by an account pay check or ECS. Uh, there shouldn't be a double deduction. It shouldn't be a case that I mean, the spouse is also claiming and the other person is also claiming. It shouldn't be that case. Uh, and this expenditure should be incurred during the period 12th October 2020 to 31st March 2021, right? And the limit is per person is should not exceed 36,000 per person. And the other condition is you should, whatever your entitlement is, you should spend three times of that amount. So the goods or the services, or goods that you purchase or the services that you avail must be three times of your entitlement, so that the entire entitlement gets exempted. So if we were to take an illustration, so Mr. A is an employee of a corporate sector and is entitled to an LTA. LTA amount based on his salary structure, say it's 1,50,000, and he has four family members, eligible family members, which means he, his wife, children, uh, minor children, I think, probably, I don't remember, but whosoever are eligible members, then the maximum amount is 36,000 into 4, which is 1,44,000 in this example. Uh, the amount which he needs to spend in order to claim the entire amount as exempt is three times of this amount, which is 4,32,000. In case he spends this amount, 4,32,000, then what is taxable is only 1,50,000 minus 1,44,000, which is 6,000. The balance is exempt. In case he spends lesser amount, then there is a proportionate reduction in the exemption. And this would be in case suppose he spends 2 lakh rupees, then it will be calculated as this. And what is exempt is 66,666, and what is taxable is 83,334. Right. So this is on the LTA part. So now we come to TDS and TCS provisions. Uh, so first, starting with some amendments which may not have too much of relevance to my mind. I mean, these amendments have been done, but I don't know what purpose this will be serving, because this is a retrospective amendment in the sense that it is effective from April 1, 2020. I don't know why they have done this. It says that in case a dividend is paid to a business trust, uh, in whose hands dividend is exempt, then there is no requirement to do a TDS. Now, uh, so the existing provision only says that TDS on payment of dividend to resident, uh, and what are exempted entities are certain insurance companies and mutual funds and all that, but a business trust is not specifically exempted there. Now they have said that exemption from TDS obligation has been extended to income paid credited to a business trust by a special purpose vehicle or payment of dividend to any other person as may be notified. Now, finance bill will only be enacted, say, sometime in the last week of March 2021. So, if it is still a bill, to my mind, companies who declare dividends will still continue to deduct tax on these business trusts. So, I'm not sure what purpose this particular amendment is achieving. Uh, Now, this is big. Uh, so they, for the first time, they've introduced TDS on purchases. I mean, in fact, they had introduced TDS on purchase of immovable property, but this is on normal purchases that they've introduced uh, TDS, and the ramifications may seem small considering that they put the rate as 0.1%, but we'll see it is quite a onerous obligation on the purchaser, especially in B2B scenarios, right? Uh, so there is a 0.1% TDS effective from 1st July. Uh, so in the existing provisions, there is no required to do a TDS on purchase of goods from a resident in India. There is a TDS requirement under section 194C if you purchase from a related party and there is a job work element which happens, right? So that's there. But in the normal scenario, there is no TDS uh, in a purchase scenario. Uh, so what is the amendment? They've said that TDS at the rate of 0.1% on purchase of goods from resident in India on amount exceeding 50 lakh rupees a year. So this is applicable, and in the normal, I mean, like in all TDS provisions, this is on credit or payment, whichever is earlier. So you have to deduct the TDS on credit or payment, whichever is earlier, right? Whichever is earlier. Uh, Now, who is required to do this? This is to be done by those buyers whose total receipts or turnover in the preceding financial year uh, exceeded 10 crores, right? So, only those buyers whose uh, turnover in the preceding financial year exceeded 10 crores. So, effectively, it would be a B2B scenario, right? So, a person who is uh, doing business will get impacted. Now, there is one exception. If on a transaction TDS or TCS is required under any other provision, then it would not be subject to TDS under 194Q. But there is an exception to this exception, and it says if on a transaction TCS is required under this, and we had seen that this was introduced only last year with effect from 1st October 2020, wherein TCS was introduced on purchases uh, or sales. Sorry, TCS was introduced on sales. Then they've said that TDS under 194Q will only apply, and then the seller need not do a TCS. So little confusing to at the first reading. But the rule is that in case a purchaser is required to do a TDS under 194Q, then no TCS by seller under section 194, 206 C1H. So even if the seller satisfies all those conditions of having a turnover of 10 crore or more in the previous year, making a sales of more than 50 lakhs, still he is not required to do a TCS if the purchaser is under an obligation to do a TDS under 194Q. So the issue will arise, how will seller know about this? Whether purchaser has done a TDS or not, or is he under an obligation to do a TDS or not? So that's going to create some practical issues, and especially more so when, uh, in order to comply with the TDS regulations, most of the sellers were actually uh, putting the TCS amount in the invoice amount only, right? And in a lot of cases, even though TCS was on receipt basis, in order to have a better control and to ensure that the purchaser actually pays, this amount was added in the invoice itself. And then a lot of times sellers didn't don't even wait for the purchaser to make the payment. They go ahead and deposit this TCS in the next month, by the 7th of the next month. So that's going to be a little complicated now, because now they're saying that if the purchaser has done a TDS, no TCS by seller. The issue is, how would the seller come to know whether the purchaser is going to do a TDS or not? Uh, but I think, I mean, those things will get ironed out, I guess. But nevertheless, I mean, to my mind, they should have ideally either deleted this or shouldn't have brought in this. But in any case, I mean, as things stand today, both of them exist, and both of them will exist from 1st June, 1st July 2021. Till that date, only 206CH1H exists, so that will have to be anyways complied. Only from 1st July 2021 will a seller be required to reassess whether a TCS is required to be done or not. Uh, so, so if someone purchases goods worth 1 CR, right, then he is required to do a TCS on the 50 lakh amount at 0.1%, which would be 5,000 rupees, right? So one would think, why break head about it? 5,000 rupees, that's about it, right? But the issue is not that. The issue is one in 206, in case this purchaser doesn't take a PAN or the seller doesn't have a PAN, then the purchaser has to do a TDS at the rate of 5% instead of 0.1%. And second, in case the purchaser fails to do the TDS, there would be huge disallowance under 40A1A. So 30% of the purchases will get stuck out or would be disallowed. And that's huge, right? And then there would be issues like, uh, I mean, purchases is not the same as COGS, right? Purchases is not the same as COGS. It doesn't mean purchases would have inventory also an element of that. Now, in case someone doesn't do a TDS on purchases, what is it? What is the amount that you're going to disallow under 40A1A, right? Is it relating to what is being booked under COGS or something else? Because you cannot possibly disallow something which has not entered your PNL account, right? So those issues will come in. That's what I foresee. But for a minor default of say not doing 50,000 or 5,000 of TDS, the purchaser stands to lose a deduction of 15 lakh rupees in this case, which is 30% of 50 lakhs, right? And that's, I think, too onerous an obligation on the purchaser. Uh, so I think whatever be the motive behind this, but this is going to be very tedious for purchasers to comply with. Uh, I can take. I'm sure a lot of you will have some questions around this. I can take that after the end of this session. Uh, I'll move to another very innovative uh, uh, twin sections that they have brought in. 206 AA and 206 double CA. These two sections have been brought in. If you remember, there was this section 206A which was brought in to enforce that people enforce PAN compliance. So it ensured that people actually went ahead and obtained PAN, uh, else they would have been subjected to higher TDS. Right now, with that having been, I mean, I would say significantly achieved, the government thinks there is another way to ensure tax return filing compliance. And so, in line with that thinking, they've introduced this section 206 AA, wherein they've said that deductor is under an obligation to deduct higher rate of TDS on payments made to non-filers of ITRs. And the higher rate could be twice the rate specified in the relevant section, or twice the rates in force, or 5%, whichever is higher. And and the conditions are that this is applicable in case the payment is made to a person who has not filed his or her or its ITR for the last 2 years, and time limit for filing ITRs under section 139(1), which is the normal time limit or normal due date, has lapsed for both these years. And so there is a second condition, and aggregate TDS in his case exceeds 50,000 in each of these two preceding years. So both the conditions have to be fulfilled. If these two conditions are fulfilled, then the deductor is under an obligation to deduct tax at a higher rate. Uh, there is a exception made that this the payee will not include a resident, a non-resident who does not have a PE in India, right? So this is an exception. Now, this requirement, to fulfill this requirement uh, for a deductor, he has to go and obtain. Does he have to go and obtain ITRs for the last 2 years from every person to whom he makes a payment? Does he have to go and obtain Form 26 AS of those guys to see whether his 50,000, there is TDS or TCS of more than 50,000 in each of those 2 years? Looks very onerous, right? And at what point of time will he check? Does he check every time he is crediting that person's account or making a payment to that account, or does he check only once in a year, or when does he check, right? So these are issues which would certainly come to people's mind as to how is this going to be applied, right? And this amendment is also from 1st July. So people will have to make changes in their software and all that to make sure that this is also captured in their accounting software. And the reason for amendment, as I mentioned, to ensure filing of ITR by persons who have suffered reasonable amount of TDS. Uh, Obviously, this increases the compliance burden on the SSC, and if there is any default, you see what are the consequences there. Uh, so, and the other uh, impact is that people will now have to ensure that they file their tax returns within due date. They cannot even afford to file a belated return. Otherwise, they will suffer a higher rate of TDS, or which could be twice the normal rate that they used to suffer. So this is also very significant. So not only for the deductor, but also for uh, 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 the payees, this is very significant, right? There are certain sections which have been excluded, certain sections of TDS like 192, 192N, which have been excluded from this purview. But by and large, most sections get covered here, right? So very important that uh, now people file their tax returns within due date. So uh, one of the consequence of not filing within due date is obviously a fine under section 234F, uh, which is 5,000 rupees. But if someone might think, okay, let's 5,000 is not a big amount, let me go and file a delayed return. But look what the consequence here that he stands to suffer, right? So government is indirectly forcing people to file their tax returns within due date. And there is a similar section for TCS. I'm not discussing that in detail, but the concept is same. Uh, same concept, where in case someone is under an obligation to do a TCS and uh, he encounters a person who has not filed his ITRs within due date for 2 years, and the TDS TCS of this guy is more than 50,000 in each of the years, then the TCS will be at twice the rates of 5%, whichever is higher. Uh, Now, we were discussing what would be the mechanism. I believe that the government will come out with a functionality which will allow deductors or the TCS collectors to know whether this particular section applies or not. So if you remember, there was this section 194N, 194N, where the banks were required to do a TDS. So if you go to the income tax website, there is this window available which says that you can verify applicability of section 194N. So you put a PAN number of that person, put your mobile number, and then go and click this, and you will know whether for this person 194N is applicable or not. Right? I think a similar functionality should be given because otherwise it's almost an impossible task to collect income tax returns of 2 years from that person. And second, why will someone share his income tax return? Because that's a very personal information. Uh, so I would think in the for avoiding any privacy issues and all that, the government may come up with this functionality because they will have data in respect of all PAN, whether this particular person has filed the tax return within due date, and whether there was TDS or TCS in excess of 50,000 in respect of this particular PAN. So once you input this here, I think it should throw the result whether 206 AA and 206 double CA is applicable or not. And this has also been indicated by the Joint Secretary TPL. So probably this would come in, but nevertheless, again the issue is that at what frequency do you go and check? Do you check it on 1st April when the due date hasn't passed, or on 1st April will it show you the results for the prior 2 years for which the due date has elapsed? What happens on 1st August when the 31st due date has elapsed? What happens then? And then with the experience of dates being extended time and again by the government for one reason or the other, I mean, I'm not sure how this software will work and will capture all that extended dates also, so that it doesn't show that someone has defaulted just because he's filed within the extended due date. So this is, as I mentioned, this is a very innovative section, but it casts an onerous obligation on the deductors and the collectors. Uh, there's one more issue which I thought I'll flag before ending. Uh, this is, if you remember, uh, in Finance Act 2020, they had inserted a new section 194O, which mandated that with effect from October 1, 2020, an e-commerce operator should deduct tax at the rate of 1% on the gross amount of sale of goods or provision of service, or both, facilitated through its digital or electronic facility or platform. Right. So this was done with effect from 1st October 2020. And this was also required to be done at the time of credit of the amount to the e-commerce participant, which is the seller, or at the time of payment thereof, whichever is earlier. Uh, Now here, 194.01 of the Act uh, overrides TDS provisions in Chapter 17B of the Act, because it starts with this non-obstante clause, notwithstanding anything contained to the contrary. Now, imagine a situation where there is a B2B e-commerce operator, right? And goods are sold on that on the platform of that e-commerce operator. So there is a seller A, there is an e-commerce operator E, and there is a buyer B. So buyer transacts through this platform of the e-commerce operator, and seller sells on this platform. Uh, so if the buyer has a turnover of 10 crores or more in the preceding previous year, and he buys goods more than 50 lakhs, worth more than 50 lakhs from a particular seller on this platform, the buyer does a TDS under 194Q. Now, since the e-commerce operator collects this money, or even if he doesn't collect the money, still, since the goods have been sold from his platform, the e-commerce operator is required to do a TDS on the seller under 194O. So now look at it, there is a TDS at two levels on the same transaction. One by the buyer under 194Q and second by the e-commerce operator under 194O. Now, I'm just trying to think. In Form 26AS, there will be two line items. One will say TDS deduction under Section 194O, the other will say TDS deduction under Section 194Q. And presumably for the same amount. And while processing the return, the CPC or tax authorities would raise an issue that e-commerce participant has not correctly disclosed its revenue in its financial statement, because 26A's AS shows a double revenue, right? And this would lead to raising of unwarranted tax demand and unnecessary harassment. So this is something which I think the government should look into. Uh, this is, I don't know whether they've thought about this, but this is a real issue. Earlier, this issue was only limited to services, but with the introduction of 194Q, I think this is becoming really, this is going to create some problems in future if this is not rectified. So with this, I come to the end of this session. I hope uh, we we could get something out of it, so something useful out of it, and there are a lot of things to ponder upon, and also to see how IT systems need to be changed uh, in the companies. I'm happy to take any questions or hear anything that you want to say on this, or any concerns. I may have an answer, I may not have an answer, but the idea is that uh, we should put it out in the open, so that if there is any corrective action to be taken, then at least that's brought to the notice of the government. Palak, can you unmute everyone?
The participants are allowed to take up their queries.
Yeah. Yes. And by the way, these recordings are available on YouTube. So in case anyone wants to, or if anyone wants to refer it to someone, he can. And those who couldn't attend one of the sessions, they can go and this is available on the Acupro Consulting YouTube channel. So this recording would be available in the next couple of hours, but the first 3 days recordings are already available. I think the Palak, the participants are not unmuted. If you could unmute them, or
So I've
yeah.
asked unmute.
Good evening, Alokji.
Good evening, Brajesh.
Yeah,
Bataiye.
today's session was nice actually because it was focusing on the practical aspect actually. These
Correct.
are the things which we used to do on day-to-day basis and more or less tedious and all those things. Actually, my question is on the last year's amendment. If we know that the government have put a cap on employers' contribution to 7.5 lakh, Above from that will be treated as perquisites in the hands of employee.
Right.
Apart from the accumulation on that part, above from the 7.5 lakh, also will be treated as the income of the employee.
Right.
So, is there any rules how to calculate the interest portion on that the accumulated part of more than 7.5 lakh? Because anyway, employers is to check the compliance on that while issuing the form 16, while deducting the tax.
Right. Unfortunately, Brajesh, I am not aware of if anything has come on that. Uh, and as I mentioned, this is going to be an issue, and this is getting more and more complicated. Uh, first you have to see what is the employer's contribution. So anything in excess of 7.5 lakh is taxable. Then interest on that
Mm,
excess. Now you also have to see
yeah, because in
what.
our case we have expat employees.
Right.
So, so actually now this financial is also going to be end. We have to anyway ensure the interest portion also being taxed in their hands actually.
Right, right. So that's where I think I'm not sure whether. As an employer, you have to ensure that interest on the excess amount over 7.5 lakhs is deducted, or
Yes, yes,
TDS on that is done,
yes,
right?
correct, correct.
Right. But on the interest part, I don't think so. You will have an obligation.
No, I think so. But that is the question actually, whether we have obligation or because we know about this contribution. It is
Mhm.
employer contribution. That's why. Do
No,
we have
but
any?
that interest is not being paid by you, right? That will be paid by the
Yes, the
authorities,
department. Yeah, yeah.
right? So I don't think so. There will be an obligation. There will be an obligation to the extent of amount paid in excess of 7.5 lakhs.
Yes, yes.
So interest element is still, I think, still not there. I mean, very frankly, Brajesh, I don't know how. So I have left employment some 10 years back, so I don't know how this interest is communicated
Mm-hmm.
these days. But I get to know that there is some SMS which comes in, or you can
Yes,
actually go and log
on
in and check.
yes, yes, yes. Actually, interest is credited on a yearly basis. Actually,
Right. And what is the timing of that
at
interest coming
In February or March, I think.
of that particular year
That,
only?
that particular round. Yes.
Okay, okay. So earlier there used to be quite a few delays in
So
communicating.
this delay used to happen this time also, but anyway, actually there is no formula, or there is no separate line item is coming in this ledger account or EPFO that
Hmm.
what is the contribution higher than 7.5. There should be a separate line item to tax this amount. Only then they will be able to because
Correct, correct, correct,
it will
correct.
be accumulation later on also. So how you will track any employee so this is
Right. And
actually
then
financially
and
is
then
going
the
to be end.
issue is
So
what happens on interest,
yes, yes, yes.
right?
That's
So
why I'm asking you. Actually, there should be separate line item in ledger account to
hmm,
tax this amount. But no such thing is reflecting in the PF ledger as of now.
right. So I
If you
think
come
they'll have
to
to make changes there so that people can readily know what is to be offered for tax.
yes, yes.
Right.
Further, in respect of 194Q new section, actually, the buyer will have to be deduct the TDS on the purchases. So in that case, it is a very difficult for the seller because seller is also liable to collect TCS. Suppose a seller issues the invoices to the buyer and buyer does not deduct tax. Now the seller will have to ask every time, have you forgot to deduct the tax or you are not liable? You are not a specified person. Maybe you have a less turnover.
Yeah. No, I mean that's what I'm saying. That I mean it will be a it will be a very difficult exercise because seller will have all the time have to reach back. And the other issue is a lot of times payments are on account payments,
Mm-hmm.
right? You don't even know whether a TDS has been done or not done, or he's
Yes,
just
yes,
made a part payment,
yes, 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 yes.
right? And because you will only get to know a TDS whether he's done or not when he files his TDS returns and you get
Correct.
a
Yes, yes,
credit in your 26 AS.
yes.
Uh,
In every payment, he will have to ask from the buyer, have
right,
you deducted TDS or you forget to deduct TDS? You are not a is specialized person or not?
right, right. So, I mean, this is going to be very tricky. I completely take your point on this. And so now no transaction is TDS or TCS free.
I think now that there is separate taxation on income, this TDS actually. Now, the way government is inserting the new section, new provisions under head chapter TDS, there should be separate act on that only. Kind of,
Absolutely. So we've already reached 194Q.
yes,
It started with only 194.
yes,
So it started with 192, 193, 194. Now we have, I don't know.
yes. Or they are very aggressive on the this TDS assessment also.
Right,
Government,
right.
because although this current presently in a practical scenario, actually TDS assessment is face to face. So that's why they are also too aggressive.
Correct, correct, correct.
And thank
Yes.
you. This is from my side.
Yeah. Anyone else who may want to add something here or uh, okay, so I think then I'll close this session for the day. Uh, uh, I mean, and obviously you can obviously come back to us and give your questions by an email or WhatsApp me or whatever. So I'll be happy to answer them. And we'll have one last session tomorrow, which is on taxation of charitable institutions or charitable trusts. Uh, and also we want to cover something on the CSR part because some changes have been done there. So though it wasn't a part of the budget announcement, but it's good to look at those CSR provisions also because of the changes which actually kicked in from 21st January or 22nd January 2021. Uh, so that should be an interesting session tomorrow. Uh, uh, and whatever else is relevant, we'll discuss that. But the main issue is charitable taxation of charitable organizations, the changes that they've done over there, as well as the CSR. Okay, thank you again. I look forward to having you again at 5 o'clock tomorrow, and have a nice day. Thank you very much.
Thank you, sir.